And so HPE is in aggressive talks to acquire Juniper for $13 billion. Welcome back, investors. So we have an interesting video today as some more mergers and acquisitions are taking place. And this is something we talked about in a higher interest rate environment. We could start seeing some more mergers taking place. You can no longer borrow money for free. Where are companies now going to go after? They're going to go after growing revenue through mergers and acquisitions. And that's something we talked about throughout the year. We're starting to see it in biotech. And obviously we're starting to see it in some technology companies. Now, the market opened up about 0.5% down and is rebounded very strong from those levels. We do have a 3-year auction taking place, so we're going to see if the market holds on to gains here. S&P is definitely wanting to push through newer highs. Underneath this bullish action, we have some opportunities that we have to start looking at. And specifically, I want to talk about, you can see here, HPE was down close to 10% on the day, rebounding a little bit here, down roughly 8% now. Now, Juniper was a company I was actually interested in. This was a smaller cap company, deals with more hardware type products, has some AI capabilities here. And so it is an interesting company, especially if we think that there's going to be a hardware boom due to the fact that AI is being distributed. The one area we don't really look at or give too much value to is actually the hardware aspect that AI might need. And so a company like Juniper, kind of positioned pretty interesting here. And I want to talk through this deal because I have done analysis on Juniper, and I thought right around $18 to $19 a share was where I would personally be interested. Could understand, paying as much as $25 to $26 a share, but HPE comes in and offers $13 billion, which is probably a 25 to 30% premium of where the stock was trading. And so when I look at this deal, I actually think it's pretty interesting, and we're going to take our emotions out of it. I think it positions HPE pretty interesting as well. They definitely want to be a serious player when it comes down to AI, and a lot of people are not taking them serious when it comes down to AI, but an acquisition like this is going to offer the hardware along with some of the software capabilities that HPE has. So I personally think HPE is pretty interesting, around $12 to $14 a share. That's basically where my ideal price target lies. And so I'm going to play around with these numbers and assume that a big chunk of this is going to be a stock deal, fairly dilutive deal overall, but I also think it's going to add value in the future. So let's talk through both HP as a business, but also Juniper. So the first thing I do want to point out is HP does trade for a low multiple here. PE ratio around 10 times earnings, a forward PE sitting right around 8 to 9 times earnings. You have price targets as low as $15 and as high as $21. And this is a company that basically has had flat top line revenue growth. And so you're probably asking yourself, well, what makes this company interesting? And to me, I think it's more of being at the right place at the right time. And there's a tremendous amount of spillover effects that's going to take place with the AI boom here. And a company like HPE could capitalize on the market share that could be coming here in the very near future. And so I tend to think that people are underestimating what they can do in the long term here. I think longer term, there could be some revenue resilience here, especially as more and more companies want to become more savvy on the AI side. I really believe that this could be a contrarian type play when we think about AI. This is a company that does between $1 to $3 billion of free cash flow pretty consistently. Earnings per share is obviously all over the place, but let's take a look at what they're getting with the acquisition of Juniper here. Now, kind of a similar story here where revenues are fairly flat, sitting right around $5 billion of top line revenue. Company shows that it can do right around $500 million of free cash flow. So if you look at a $13 billion purchase that HPE made, you're basically looking at a little over 2.5 times revenue, probably close to 25 times free cash flow, and probably close to 20 times EBITDA. So a little bit of a premium here, but I wouldn't say it's anything outrageous. This is not a company that's losing money. This is actually a profitable company, has shown profitability for an extended period of time. This is a company that IPO'd over 20 years ago and has dealt with some ups and downs of market volatility and is shown to be pretty resilient here. So I don't think this is an awful purchase overall. I definitely want to see how management's going to implement this, and I want to see what kind of demand's going to be out there. But from a strictly valuation standpoint, HPE trades for a pretty low multiple, and there's not much growth within the company, but are they at the right place at the right time? That's going to offer some opportunity here, and I think that there is some sort of opportunity here when AI starts getting more and more implemented into our daily lives. We're going to need more hardware. There's going to be more software needed. And so I do think companies like HPE that are kind of getting overlooked and are trading for low multiples are actually kind of interesting to own. And I think it's even more interesting the fact that they are acquiring a company like Juniper and they're getting aggressive on the M&A side of things. They don't want to be surpassed by other companies and they want to have a decent footprint in this AI boom that we're about to go through. And so I do think this is pretty interesting. So if this becomes more of a dilutive deal here, I want to start plugging in is HP's, if it's a $13 billion deal and it's an all stock deal, then that's going to dilute shares roughly by 1 billion shares. HP is trading right around $16 a share, $13 billion deal. So just to err on some caution here, I'm going to build some safety. So they're projecting out 2024 for HPE to do 29.9 billion. And when we look at Juniper, they're projecting them to push over $5.5 billion in top line revenue. And so when we look at a multiple to EBITDA, we can see that HPE is trading for 6.5 times enterprise value to EBITDA, while industry standards actually 16 times. A very discounted stock when we compare it to its peers, rightfully so, as we've explained in the past. No major EPS growth, no major revenue growth, nothing crazy coming down through free cash flow. So the fundamentals are just saying that this is a stagnant company. And so you get a stagnant price and a low multiple, which completely makes sense. And when we look at Juniper, basically trading in line with its peers and with an EV to EBITDA, still trading at a discount to its peers. So currently I have a 9 times multiple on EV to EBITDA here, and I'm just going to bump it up to right around 10 times. And that gets us between a $13 to $14 price target. So as you guys can see here, the thesis I'm building is that if revenue kind of stays flat and the company is just combining the two revenues together and getting some stronger free cash flow, but also making a dilutive move here, then obviously I need to be buying the stock at a lesser price here because there's more dilution, there's more debt being taken on, and the fundamentals are not going to supersede that dilutive move. But if they can actually get some margin expansion and revenue growth here, and I'm talking very mild revenue growth, I went basically from doing 4% revenue growth across the board, saying that they can do 6% revenue growth from years 1 through 3, 5% revenue growth through 5 through 6, and then 4% revenue growth through 6 through 10. Kind of makes the stock an interesting purchase. Kind of makes the stock pretty close to a buy at these levels, basically putting it right around a $15 price target. So I think anywhere that this thing falls in between the $13 to $15 price target makes the risk versus reward pretty compelling in this one, because even if these two companies combine and it's a dilutive move and they only grow revenue by 4% consistently, then we're looking at a $13 to $14 stock price and hopefully a future value of right around $30 to $34 a share by 2032. And so this does become an interesting deal here, because the question now becomes, can HPE now with Juniper actually have more revenue growth because they just happen to be at the right place at the right time? And with AI now becoming a huge part of people's lives, we're going to need more hardware, more software, and the spillover effects for their businesses could actually outperform what revenue growth is expected to be. And they're basically saying that they do want to be better positioned for an era of artificial intelligence, and that for every dollar of wireless, there's actually $2 to $3 of wired switching opportunity for us to pursue. They're basically saying there's a 2 to 1 effect that's going to be taking place that's kind of getting overlooked. Basically what I'm stating here as well. And just an account check-in here, we haven't added any more to Bristol Myers Squibb. The account sitting at $29,421. And you guys can see exactly where 68% of my portfolio is, just sitting in a T-bill here that's going to mature over the next few weeks. And so we're starting to pick our spots here, as you guys can see, and I'm kind of enlightening you on exactly what my thought process is. So hopefully you guys enjoyed my dive into the merger that was taking place, and we will see you in the next one.